Hi everybody, welcome back to another video. So in this video, I'll analyze on a REIT that has been requested by one of the viewers. After looking through it and the share price seems to have been bashed up, it's a very good REIT to look into as it provides opportunities for investors. And that REIT will be OUE Commercial Reit. OUE Commercial Reit is one that consists of mostly Singapore properties and with only one China property. It has assets in three categories and they are office, retail, and hospitality. This is good for post-COVID environment since these three categories are the recovering categories. However, if we look at the share price historically, since listing at 2014 at 80 cents, it has dropped by 58% to 29 cents now. Of course, if you're invested in them since the IPO period, the returns might not be as good. But this does not mean that it does not provide a good opportunity at this kind of low prices. If you have stayed in Singapore long enough, I'm sure you have heard of these properties, especially the hotels. In the office sector, they have OUB Bayfront, One Raffles Place, OUD Downtown Office, and the Shanghai office, which is Lippo Plaza. These are all grade A properties in optimal locations for offices. What I like about Singapore offices is that they will always be in demand due to limited space in Singapore. Multinational companies recently are actively coming to Singapore as they consider us a much safer and stable country. They also have retails in Mandarin Gallery, world famous hotels such as Hilton Singapore Orchard and Crowley Plaza. Now, let us dive straight into their results. As expected, with the recent recovery environment from COVID, the results is amazing, with revenue and net property income increasing 27.5% and 29.8% year-over-year respectively. However, this year-over-year comparison can be exceptional due to the recovery from COVID when it compared to last year. So to be more precise, we will have to look at quarter-over-quarter and comparing results from pre-COVID. In this case, we will use the Q4 of 2019 results as a comparison. If we look at the table, Q over Q results is quite healthy with increase in revenue and net property income by around 7% and have been on the upward trend for full year of 2023. However, if we compare with the Q4 of 2019 results, revenue and NPI are still down 14% and 12% respectively. This can be a good thing as it meant that there's still potential for recovery for OUE REIT to pre-COVID levels. Now, it's important to account for the finance cost, which is the interest payments to debts, as it is usually the pooling effect for all REITs. If the revenue and NPI continues to grow, there's a chance that the dividend might come in higher. However, do take this assumption as a pinch of salt as the finance cost might come in higher as well. This is the main issue for most REITs nowadays. Even though their NPI and revenue continue to grow due to strong rental reversions, the increase in the interest payments of debts will lower the dividends. Therefore, it's important to account for it. At the share price of 29 cents, it will give a reasonable dividend yield of 7.37%. However, if the finance cost for Q3 and Q4 comes in much higher than what I am predicting, the dividend yield might drop from 7.37% to 7.24%. If we raise it even higher, of course, the dividends that come in will be lower and thus the yield will be lower as well. So this is something to take note of, especially for REITs that have lots of debts that needs to refinance in this high interest period. If you like the information, appreciate it if you could support my channel by hitting the like, subscribe and comment on what do you want me to work on next. Thank you, and let's continue with the video. Let's go back to this slide. Commercial properties had an impressive rental reversion of 18.4%. Hospitality was helped by the recovery in tourism and lots of post-COVID events, increasing 67.6% and 73.2% for revenue and NPI respectively, which is very impressive. Retails also recovered nicely with 31.1% rental reversion. Like I said before, comparison between year-over-year results might make the results look extrapolated and amazing. Therefore, it's important to look at how they recover as time passes and compare their Q-over-Q results. Commercial-wise, there are potential for growth as passing rent is at $10.35 per square feet. Expiring rents in the next 2 years are lower than the passing rents, so expect rental reversions to continue to be positive and improve the incomes from the commercial side. Like I said before, I feel that Singapore commercial properties will benefit from the world's current environment as MNCs will start moving to Singapore, which they might feel is much stable and safer. This will continue to prop up the demands for commercial in Singapore, and hopefully it goes well in the next few quarters. Lippo Plaza is not doing so well with passing rents continue on the downward trend. Honestly, I'm more optimistic for the Singapore commercial property as compared to the China commercial property. Retail side of the REIT is the one property which is Mandarin Gallery is performing well with shopper traffic near pre-COVID levels of 98%. However, tenant sales are not doing well at 83% of pre-COVID levels, and passing rents are continuing on the downward trend even though there's a 31.1% rental reversions. There is always a risk that e-commerce might endanger retail business. However, in Singapore, I feel that people like to go to physical shops, which can be seen from the crowds in the malls. Hopefully, the high shopper traffic will help to boost up the tenant sales. This might in turn convert to a higher average passing rent, which will give higher income. Hospitality continues to improve with Hilton Singapore Orchard being fully functional at 1,080 rooms compared to 634 rooms last year. With huge demand in tourism and the increasing events, the RevPAR, which is revenue per available room, is at a high level of $295. This is much higher than $209 in pre-COVID levels. Now you know why having staycations in Singapore is no longer worth it cause it's so expensive. But this is definitely a good news for investors. Debts are very important to look at because REITs operates on debts. With leverage ratio at 39.4% and adjusted interest coverage ratio of 2.4 times, it's actually quite bad. The interest coverage ratio will need to improve. Good thing is that it will continue to improve as long as the properties continue to do well and interest rates do not increase. Another positive note is that it improved slightly from the last quarter of 2.3 times. The average cost of debt is at a high level of 4.2%, but after obtaining the BBB- rating from S&P Global, they are able to reduce the interest paid on one of the fixed rate notes due in 2027. This shows how important it is for REITs to get graded by consulting companies such as S&P Global and companies such as Moody Fitch. The gradings will affect the interest payments on their debts, as higher graded REITs will definitely have the advantage of having lower interest debts for their payment. One example is Ascendas REIT with a A3 Moody rating and an average cost of debt of only 3.3%. So when it comes to investing in the REIT, this is one of the factors to account for when it comes to investing as well. Even though historically OUE REIT share price hasn't done well, in this environment there might be potential for it to continue growing thanks to recovery from COVID environment. Past performances doesn't determine future performances, and lower share price would definitely provide opportunities for good returns. Thank you so much for watching. I hope this video gives you good information on the REIT itself. Please support the channel by hitting the like, subscribe and comment on what you feel about the recent REITs performances as well. You can also watch the recent analysis on other REITs here. Thank you, invest safe, and I'll see you in the next video.